When a property is assessed, a tax rate is applied to the assessed value to determine the taxes due. The tax rate is not specific to the property, but applied throughout the jurisdiction of the taxing authority. Remember, property taxes are largely used to fund governmental operations. As a taxing authority begins the process of setting a tax rate, the first step is to determine the amount of revenue needed to fund their operations. Most governmental agencies work on an annual budget. The budgeting process is typically long and drawn out. Expenses and revenues from all sources are estimated. While the property taxes represent a substantial revenue source for government agencies, they are not the only source of revenue. Sales taxes, income taxes, and building permit fees are just a few examples of other revenue sources available to governments. A government agency determines how much revenue they need to capture through property taxes during the budgeting process. From the assessment process, the agency will have the total value of the properties in its jurisdiction. These two numbers are then used to calculate the tax rate. Assume a government determines they need to collect $10 million in revenue from property taxes. The assessor has determined that the total assessed value of all properties within the government's jurisdiction is $250 million. We must now calculate the tax rate necessary based on the assessed value of the properties to generate the income needed. If we divide the income needed by the assessed value, we will have our tax rate. If the property is taxed at a rate of 0.4%, property taxes will generate the required $10 million in income for the governmental agency. We have oversimplified this process for illustrative purposes. The taxes on a particular property may usually include taxes levied by several organizations. For example, a property may have taxes levied by the city, county, and school district. Each entity will have a separate tax rate. The tax rate of all the applicable taxing authorities are added together to calculate the total tax rate on the property. Some taxing authorities express their tax rates in mills. A mill is 1/1000th of a dollar. In other words, 1 mill would present a tax rate of $1 for every $1,000 in assessed value. Our 0.40% tax rate would be equivalent to 4 mills, or the tax rate is $4 for each $1,000 in assessed value. The tax rate is applied to the assessed value of a property to determine the property taxes due. We will continue to use our example of a 0.4% tax rate. Let's assume the county assessor determines the value of a property to be $500,000. The calculation of taxes due is as follows: $500,000 assessed value times 0.40% tax rate, $2,000 property taxes. If we wanted to use mills, the tax in this example equals $4 for every $1,000 in assessed value, because the tax rate is 4 mills. $500,000 divided by 1,000 equals 500 number of $1,000. 500 times $4 equals $2,000 property tax. The tax rate is usually uniform for all properties. If the taxing authority wishes to make adjustments for certain taxpayers or certain properties, the adjustment is often seen in the assessed value. Taxes are assessed on an annual calendar basis. This means taxes are assessed for the period from January 1 until December 31st. As we discussed in lien priority, property tax liens typically enjoy first priority regardless of the filing date. A tax lien is usually considered filed on January 1 of each year for the current year's tax bill, even though the amount of the tax bill is not determined until later that year. Since tax liens typically take priority, even over mortgages, lenders will often pay the property taxes due. They would rather pay the taxes than allow the property to go to a tax sale. The laws regarding the enforcement of tax liens differ greatly among jurisdictions. The property owner will often have a right of redemption after the tax sale, which allows them to pay the delinquent taxes and retake possession of the property. Special assessments. Special assessments are used to pay for improvements or facilities which directly benefit certain properties. For example, a neighborhood may include a city park. Rather than increasing property taxes citywide to pay for the park, a special assessment may be used. A special assessment would place the financial burden of building and maintaining the park on the homeowners in the neighborhood who directly benefit from the existence of the park. The homeowners in a neighborhood would be obligated to pay a fee to the city monthly, quarterly, or annually in connection with the park.